Hi, my name is Drew Farrell. I'm the Senior Vice President of Symetra in the Retirement Division. And I'm joined by Dave Kansas. We're fortunate to have Dave as a consulting partner to talk about all things financial services, the sector, behavioral finance, marketplace. Dave is a gifted journalist who has a long career in both being an editor with the Wall Street Journal, thestreet.com, and he's actually been commissioned by Dow Jones to write a number of different books on financial literacy. So we talk quite a bit, a lot of different topics, Dave, but it all kind of wraps into something that we're spending a lot of time examining and discussing with our financial professionals and partners and, mutual clients and it's the whole idea of behavioral finance. Not a new topic, but in the here and now topic, you have people retiring, you have people in the workforce taking care of people retiring. There's a lot of complexity here. What are some of the things that you're observing in the past 2 years, and then maybe put your prognosticator hat on, for the next 3 to 5 years that people really should be paying attention to as the shift of wealth happens that we discussed, but also, you have a president and administration, call it 2 years into a lame duck, but does it feel like a lame duck administration? Not really. What is this all looking at, and what should we really be focusing and paying attention from a behavioral finance point of view or lens?
First, in the behavioral finance piece, I mean, in 2025, we got a great example of how emotions can carry investors away at the exact wrong moment. And Symetra wrote about some of this as the markets had their hiccup, and it's fairly significant, more than 20% off the highs in March and April around the tariff discussions. Um, but if you had, and the newspapers were filled with people say, "Get me out, get me out, get me out. I can't deal, I can't deal." And if you'd had the kind of relationship with a client that said, look, your emotions can't drive your long-term investment goals. You need to stick to those goals. We've talked about them. Yes, it's very windy outside, a little bit stormy, but this is the time you gotta hang tough and not run for the exits. And there weren't enough of those conversations going on. So good client relationship would have that conversation ready to roll, probably doing it before then. And that's really, really important. In terms of behavioral finance in other ways, I think what is sometimes lost on investors is the sense of what is diversity really like, right? So diversity is mostly talked about like, well, don't just own the stock in the company you work for. Well, that's not diversity because, you're kind of doubling down on just your one place. A lot of people still do that, despite that being written about fairly frequently. And then they think about diversity as like, well, I'll hold 10 stocks instead of one, or maybe I'll invest in the S&P 500 and do this or that. But diversity really, as you approach that retirement age, you need to be thinking about, okay, what in my portfolio is providing a predictable source of income? What is perhaps modestly riskier that might have some upside, but also some downside risk? What is my mixture of stocks versus bonds versus annuities? How am I structuring this whole portfolio so that it is diverse in and of itself
Hmm.
across different asset classes, incorporating some different strategies? And I think, candidly, that's hard for individuals to sit down and do, that they need guidance and they need advice on how to do it. But that's a piece of diversity that I think is really, really important and is often overlooked.
That's a great segue to, you mentioned the S&P. It's certainly not as diverse as it used to be in terms of weighting. Do you think consumers truly understand that? It's rarely mentioned out there within, call it mainstream publications, just how overweight the S&P is on a handful of stocks.
Yeah, so the S&P 500 is a weighted index. The Magnificent Seven,
Hmm.
which are a bunch of tech companies, um, they have an outsized impact on what happens with the S&P 500 because they're so huge that they become a bigger part of the S&P 500. There's still always 500 components, but you have 7 to 10 that kind of call the song
Big overweight
right now.
positions.
And which is why I've always defended the Dow Jones Industrial Average, which is not weighted, but is a price index. But nobody listens to me. So they stick with the S&P 500, but they should understand how that weighting works and why that can create a mismatch between perception and reality, right? You could say, man, SP is going great, and all these companies are closing in my neighborhood. And that's because S&P is leaning on, this tiny portion of its 500 components to go up or to go down. And it is seldom as outsized as it is right now in terms of the impact of a few on the whole.
Further discussion, a lot of press on, does the 4% withdrawal rate in retirement still hold steady and true? And is a 60/40 portfolio still the navigation to get there? But there isn't necessarily a conclusion. Do you have an opinion on both of those?
I mean, my view is the 60/40 approach has become inherently too cautious, in my opinion, because a lot of people who can afford to spend time with a financial professional are living longer lives. Um, and I think if you're going to live to 100 years old and go to almost half fixed income, 40 years before you get there, that is going to be a tougher equation than it otherwise could have been. You certainly, as you get older, you want to get safer. The basic concept is one that's sound, but it's like, how do you do it? And it's really hard to do it for everyone. You almost have to know your client and kind of where they're at in terms of how long they expect to be around.
So it's not just risk tolerance, it's longevity.
Longevity is a huge part of it,
Yeah.
right? And
Which is
and and,
maybe
and we
not.
haven't talked about it a huge amount, but people not having enough money to get to the end of retirement and what that's like. And a lot of people like me have kids at home, and then maybe my parents will be at home at the same time. So
Right.
those kinds of things happen.
So that leads to the 4% withdrawal rate.
Yeah, so the 4% withdrawal rate, I think you need to measure that against what you truly need,
Okay.
right? I mean, I think the government and other policies force you to withdraw a certain amount every year. Um, but 4%, I think, is a handy number that works for most people. But again, we're trying to do an average for, millions of different retirees. And they're each going to have different situations in their lives. Some might still, they got married late, they have young kids. Some might have got married early and they're empty nesters and they're ready for moving to, a place where it's nice, warm, and sunny. So everybody's going to be at a slightly different area, and that 4% is a nice basic handle. But advisors have to have, great advisors have to have the flexibility to kind of recognize the real needs of the client against the long-term requirements of the client and what they want to do kind of in the early stages there, especially.
Dave, thanks for the conversation. We appreciate your partnership and you and your contributions.